Welcome back, everyone, to Vox Markets Live. My name is Paul. I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small cap. So welcome, Paul.
Thanks, Paul. Hello to everyone. I hope you didn't miss us too much last week.
No, but Harris was just saying, oh, you're probably having a siesta this afternoon. That's why we were just a touch late. But anyway, it's great to...
Yeah, I'm going to say, unfortunately, it's so hot. I've got to have a fan on in the background, and it's just started blowing papers and magazines all over the place. So we could have assorted random things flying into me.
Well, that'll certainly make it interesting. But it's great to have you back on this show, especially as I've had a lovely week out in North Wales, Abersoch. But before we sort of start running through specific stocks, just more broadly, having just gone through the first half, what's your outlook for equities for the rest of the year?
Well, it's tougher than I thought, actually. The macro picture, I think the last 2 weeks have definitely been characterized by quite a few big increase really in profit warnings. I think we're starting to see now a definite slowdown in quite a few sectors. So yeah, it's not as, perhaps I was a bit rose-tinted about the outlook for the rest of the year. I don't know, but I think it's looking a bit more wobbly now, Paul, isn't it? And when you combine that with the very powerful rally, well, the V-shape crash and then rapid recovery, I think we need to be a lot more skeptical now about valuations. A lot of things have gone up possibly too much, I think, whilst there are still plenty of bargains there as well.
Yeah, I mean, it's difficult to say whether this is just a temporary slowdown or whether it's something more significant. I would say a lot of people came out with their prelim results in March, April time. And of course, everybody who was manufacturing was stuffing product into the States and selling unbelievable amounts. So their start to the years were pretty strong everywhere in the world, okay? Now you've basically had 3 months, the start of April, where you've had Trump's tariffs, which clearly has slowed things down because you've basically still got inventory to work through. So you've had this sort of like, this is going to be the Q2 is going to be the first quarter where we actually see the effects coming through corporate results. I think in the States, Q1 results, earnings increase were nearly 14% like for like. In the second quarter, the analysts, who usually are reasonably conservative because they bid it down to beat expectations, but they're saying 6%. So we are going to start seeing it. And so when you think it through that lens, the number of profit warnings we're now seeing, they could just be caution in that second half because they've slowed it down. And I would also add, and I know we'll talk about it later, I think the same thing has happened with the house builders in the UK because we've had that huge rush to buy houses in the first quarter to beat the Help to Buy. And the second quarter has just meant a slowdown of transactions. And you've seen that coming through the RICS surveys. But I personally think the economy will improve in the second half and after this sort of 3 months. But I'm with you. I remain cautious in terms of the overall look, simply because I think valuations 22 times is on the S&P. Nvidia just went through $4 trillion market cap, which is obviously a bit of a stretch. And I'm holding now 15% cash. What's your sort of cash holding?
Nil.
You're fully in.
I'm always fully invested. But I think, again, selectively, there's a lot of stuff that hasn't bounced particularly. I'm looking at the laggards where they're putting out good trading updates. But I've also, I am half expecting some profit warnings. I've got 40, 50 positions at the moment. Most of them are bunched together at a similar size, sort of small to medium sized positions, because I do accept that in this type of macro, there will be some nasty surprises. You can't avoid profit warnings. They often come from the least expected sort of place. So I'm braced for maybe some mild profit warnings from some of my positions. But I think retail should be okay because Richard Crowe was talking about this. He was saying that the stronger pound against the dollar could be very good for their margins. And we've had a couple, I think, saying that margins are improving. And despite all the doom and gloom, consumer confidence is actually okay-ish. And a lot of people have had big pay rises in recent years. I saw some data that I think it was between 50 and 70% of households said they are living comfortably. Yeah. But the media are always focused on the smaller number who are, struggling, because that makes a more interesting story. So, and the savings ratio is very high in the UK now. So people have got the money. It's quite an interesting setup, I think, actually.
Yeah, I think some of the savings ratio is simply because everybody, particularly from the government, was still working at home, and therefore they're saving all their transport costs, which they didn't get through the pandemic, and it just adds like 2 or 3% because it used to be expensive having to buy a season ticket heading into London. But just with you said you got 40 to 50 positions. How come? Because normally you sort of like have a concentrated portfolio like I do, but how come you've got so many at the moment?
Well, because I suppose, partly because I don't want any profit warnings to damage me too much. I've had 2 actually in the last fortnight, Greg's and MS International, neither of which did much damage really because they were smallish positions. And I'd be inclined to buy more of them. I like to be in companies where if they do dip down on a slight disappointment, I can just buy more cheaply. So I don't necessarily see profit warnings as a bad thing. Why do I have so many positions? I suppose I just want to spread my risk at the moment. And I don't really want to go kind of all in with any more oversized positions. I'm sitting tight on Plexus. That's still my biggest position. And they put out an operational update that was, I thought, quite encouraging this week. But it's a slow burner, that one. I'm not expecting it to do anything immediately. So
we'll come on to that. We'll come on to that in a moment. So
okay, let me throw it back at you, Paul. What's your portfolio construction at the moment?
I've still got about, I don't know, 18, 19, 20 positions. But the point you make is absolutely right with me. I go concentrated, and unfortunately some of the big positions do go blow up as I've talked about, which has been very bad. But just overall, what's your sort of like performance of your portfolio in that first half? I mean, I'm amazed because I got totally taken to the woodshed on Argentex, which lost 11% of my portfolio. But I'm actually, given the rebound, I'm actually back now to level. I'm still 8% below my benchmark, which is the FTSE All Share. So I'm still way below. But have you performed this year so far?
I don't know is the honest answer. I don't really measure my year-to-date figures because it's just an arbitrary start date and an arbitrary end date. My SIP is doing all right. That I would imagine is probably up this year. I think my geared account that I do all my smaller trades through, that's doing really, really well. Obviously, it took a big hit in April, but it's more than fully recouped that. So that's decently up year to date. Sorry, I'm not trying to avoid the question. It's just I genuinely don't know the numbers. My published favorite shares lists are slightly above the market. They're about 9% up year to date. And the benchmark I use is AIM because that's closest to what that's up about 7%, I think. So, but I've also had quite a few divvies on the list of my favorite shares this year. So, but it's interesting how they fanned out. Some of them, like Renault, there was a takeover bid. H&T, there was a takeover bid as well. But I forgot to put that on my blooming list. So I might adjust the numbers to include H&T. Because it was.
I mean, I think I tip my hat, Paul, because if you've done sort of 7, 8 high single-digit returns in the first 6 months, that's great. Because to be honest, you didn't do badly in 2023 and 2024, did you? Because you were sort of like 20% up in both years as well.
Yeah, no, my top 20 massively outperformed the markets in both 24 and 23. So I'm hoping to make it a hat trick this year as well. But
you're getting greedy there, Paul.
Yeah, being greedy. But interestingly, you can take the odd profit warning. It's like I've had 3 or 4 real clangers in my runners-up list that have dropped about 50%, like Eagle Eye, like Seeing Machines, several of them. But it's all been absorbed by a takeover bid for Renault, and so it's quite surprising. You can take a hit to your portfolio, if you spread it over about 20 shares.
Just as if they go monumental, that it's a bit of a stretch, but never mind.
Okay.
So have you been buying? I've obviously had a couple of weeks off. Have you been buying and selling anything so far over the last couple of weeks?
Yes, I wanted to raise some cash because I needed to take some money out, so I had to close some positions. So I've sold the last of my RWS, because I just wasn't convinced by the CEO's new
That's
strategy.
the translation software type business.
It is. Yeah, I bought those nearly at the low. So
Yeah,
it was a successful trade for about a 20 or 30% bounce. Not convinced by the new strategy. It just sounds like hot air to me. So for that reason, I sold the last scrap of those that I had left. What else did I sell? Oh, I banked my profits at MNC Saatchi. That's again been a successful trade from about March or April. So I think the valuation there is probably up with events given macro. What have I bought? Oh, I've topped up my position in 4 Imprint. I think that's very good. I sold some Ys. I only held those a few weeks, but with the intention of rebuying it. And of course, it's gone up 5 or 6% in 2 days after I sold.
I know how it feels.
Yeah, and a few other bits and bats like that, but none of my core position. Oh, I bought some more Hollywood Bowl, just topped that up a little bit. I think there's probably a profit warning coming there, but there's been repeat director buying. A reasonable size, 25, 50, 60k director buying in pound terms, which isn't done for fun, is it, or to mislead people. I think director buying over about 50 grand is telling you something pretty positive, I think. So I like there's loads of opportunities, I think, still out there despite this big market rally. Have you done anything, Paul?
Yeah, I agree with you on Hollywood Bowl. I think it's just a timing issue in terms of if it has, people obviously are out, in the sun like I was in Abersock rather than playing 10-pin bowling. So if you want to get into a position of, potential takeover target, then this one looks really cheap. I think would be my take on it. Yeah, I've actually done a couple of things. I've actually sold my final bit on Tracsis last week.
Oh, have you?
Yeah, and I put it into, I needed some money, so I put it into Treatt, which is the natural flavors and fragrance. Because I had a hard position. Sorry, I had a half position. And the reason why I'd been, because I bought before the profit warning about 3 months ago.
Yeah.
And I was nervous about the second half in terms of, I've always liked it as a long-term story. But in the short term, I thought it was a decent chance of actually being a profit warning. However, because of I know it sounds bizarre, I don't know whether I'm right or not, but because it's been so hot and so warm, record temperatures across the UK and Western Europe, and even in the States to a certain extent, if you're a supplier of natural flavors and fragrances into drinks, cold drinks, carbonated drinks, which these guys are, they should be doing well in that second half. And you just look at the share prices of AJ Bar, which is the Nichols, and Nichols. If you look at the Iron Brew guys and the Vimto guys, they're doing pretty well, and they're selling a lot. So I actually think the risk of a second half profit warning for Treatt is actually a lot less, and that's why I bought it. And so I've bought my second half position. So I bought a position in that, and then I also topped up on my Eagle Eye shares.
Okay. Yeah.
For basically, software discounts, because they made a nice little acquisition, a payments business, or basically just promotion business, not payments business, which is similar to them, and they can do cross-selling of to the customer base and upselling of their software into Eagle Eye's business. And obviously, the history of Eagle Eye is that it obviously had that huge profit warning about 2 months ago because it's that big contract out to one of its channel partners out in the States.
Yeah, I mean, that was a bit of a one-off, that profit warning, wasn't it? But it really did. I don't think the company had previously highlighted that it was so dependent on one particular customer. So that really put me off Eagle Eye, actually. I'm still... I mean, I didn't own any, thankfully, but I'm not inclined to buy Eagle Eye. The other thing I think with it is that these contracts are quite slow and laborious to negotiate and set up. I think it's at least a 6 months lead time to a new contract win. So I don't know on that one. I mean, I did like it previously, but it's obviously it's let investors down really more recently. But it does look cheap for a recurring revenue software business. So I don't know. I'm in 2 minds about Eagle Eye. Not negative, not positive. And then what was the other one? Treatt. I mean, the only issue, I did buy this actually at around £2.20 after the profit warning. Normally my falling knife trades fail miserably, but this was, I think at the time, 100% asset backed, wasn't it? With modern factories, they've done all the capex, but it does seem to have some internal problems. I think Treatt seems to be suffering from some competition issues, I think. So I'm not sure how the macro side of it, how relevant that would be, but it's drifted down a bit now. I made a nice trade on this, made 20-30% profit. So I sold them at about £2.60. Yeah, I would consider buying back in. It's now £2.49, isn't it?
Yeah.
12, nearly 13 times forward PE, 3.5% yield, and only 1.1 times net tangible asset value. So, do you think it could be a takeover, a bid target, Paul?
Definitely. And also, I did see last week, unusually, there was a million stock trade at £2.45 about 2 days ago.
Okay.
And I'm just looking at the actual numbers now. And that is, it's 61 million shares. So that's quite a big chunky. So a million out of 6, it's not far, about 1.5% was bought as a straight in and out, which says to me that somebody's accumulating. But hey,
yeah, sounds like, but somebody's selling as well.
yeah, no, absolutely. Yeah, I mean, there's still short-term risk, but I like the long-term story on it. So anyway,
and it's got very nice secure funding. That's the other thing. Balance sheets. I know I probably overemphasize balance sheet strength, but I think particularly where there's been a profit warning, there's maybe some competitive or operational problems. That's when I think having that really strong balance sheet position with net cash or negligible debt, no real capex requirements in the short term, I think that really protects your downside risk very nicely. So yeah, I think Treatt could turn out to be quite a good call, actually, Paul. Yeah, I might. If it keeps falling, I might go back in.
Yeah, we'll wait and see. Okay, if anybody wants to ask Paul any questions, please put them in the chat bot and I'll read them out. We've got a ton of them.
Paul, one of my readers said, can you mention to Paul Hill that it's not a chat bot, it's a chat box?
Oh, okay, chat box. Okay, no problem. So thanks for that. That's very helpful. Okay.
I promised him I'd tell you. So.
Yeah, okay. We've got two people. We've got Adrian DeMade and Harry both asking about Celebrus Technologies, which we talked about 4 weeks ago as a potential opportunity. It does sort of like it's got data sort of aggregation software that helps its clients to decide what behavior their end consumers are doing. So if they're surfing and trying to buy stuff on the web, it will help actually understanding that behavior to get them to actually purchase more from that particular website. And it also uses the same technology of analyzing web behavior to do cybersecurity checks as well. Came out with its results, reset the bar. The shares shot up. What was your take?
I was very surprised the market reacted so positively. You're right. I think it was the biggest riser on the day. It was up, I think, at least 20%, although it has been in a massive downturn previously since last autumn, because it warned on profits in April and said it was going to change its business model and the accounting for revenue, the revenue recognition would go over to a SaaS basis. So forecasts were withdrawn. The results, as you say, I think it was March, wasn't it? March 25 results. They were good. It showed nice profit growth, a very, very strong balance sheet at Celebrus. It's got tons of surplus cash. So again, it's one of the things I look for. So it was definitely on my radar as something I nearly bought on the opening bell after reading the results. I thought, this thing is dirt cheap. However, this is the thing. The 2 or maybe 3 brokers reintroduced forecasts and profits have gone. Not just, dented a bit. They've literally gone for the next 2 years. There's probably a few listeners and holders of the stock shouting at their screens, no, they haven't gone, they're just deferred. Well, it's literally now forecast to make 0 profit or even a small loss in the current year and the next year. Whereas back in December, before they announced this change of policy, it was forecast to make between $9 and $10 million profit. So to me, the investing case just got much, much worse. It's not now a highly profitable business. We're now being told it's bumping along at break even, and we've got to wait 2 years for profits to return, which I just think is a significant deterioration in the bull case. So no, I'm not interested in this one now. after that. So it's a very interesting company, though. There's no doubt that what they do is, you could see that really taking off, but it's kind of never got there in terms of, it seems to be almost capped at a certain level of revenue and profit. And we now find out that the profit was, was created on aggressive accounting treatments. So no, I can't get excited about this, I'm afraid. Have you looked at it, Paul?
Yeah, it surprised me. I read the announcement, and when they looked at the broker report, I'd have put a lot of money that was going south. The share price, it was going to fall a lot, but yeah, to go up by 20%. And the only real sort of understanding the rationale I could take from it was actually they've kitchen sinked their numbers, and therefore going forward they're going to beat it, and that's how the market recognised it. It just was like, okay, well, they've set it so low that actually they're only going to beat, and that's why the shares went off, and it was a bit of a sort of like a relief rally as much as anything. But no, I'm with you. It didn't exactly engender huge enthusiasm for me to buy the shares, because I was surprised. I mean, they effectively took the sales down by 25% year on year.
Yeah,
and wow, that's massive.
Yeah, it is. And I mean, they did say we've got to try and be balanced on these things. They did say that a lot of it was low margin sort of pass through type recharging for hardware, and that they're not going to do that anymore there. So I understand the bull case here, and I think bulls as well will take the cash off the market cap to come to a much lower enterprise value. I have a feeling the cash, I think, is about a quarter or a third.
Yes.
About a quarter, I think, isn't it? So that is genuinely surplus net cash. It's not, just all the customers have paid up front. I can feel a hiccup coming on, so I might have to use my Gaviscon.
You filled that with a tinny, haven't you? It looks like Gaviscon, but it's real Stella or something like that.
The beer's in here. Okay. So but getting back to Celebrus, I do think there's an interesting bull argument on it. So people might then look at EBITDA and the enterprise value and match those up and say, well, actually it's reasonably priced. And even though that's not how I personally value companies, I've got to acknowledge that is how takeover bids are priced, aren't they? So a lot, and talking to your friends at Harwood, that they're stable of fund managers who are all brilliant. I think they are just such clever people. They never talk about PE. They go on EBITDA. So if everyone else is valuing companies on that way, we've got to kind of follow the crowd, really.
I would say what they do is they do it on adjusted EBITDA. So if there's a big sort of like rental roll on it, because of EBITDA, then they do it EBITDA after rental after the rental payment. So they do adjust it, and to make sure that it's a cash EBITDA. It isn't just a straight EBITDA. So they're not.
No, that's true. And a lot of companies do that in the reporting, don't they? Retailers and things like that. They'll give you a kind of EBITDA that's a bit more sensible, not just the ridiculous IFRS 16 numbers, which, oh God, I wish they'd repeal that. It's just useless, isn't it?
In that same sector, we've got another sort of like software darling. We've got System 1, which came out with a relatively slower start, I think, caused by sort of Europe and the UK sales. I think the States is still going okay. These guys basically do software that I believe helps simulate advertising campaigns and help the users predict how successful an advertising campaign is before it's actually launched, so you can amend it before it goes live. So it's dead useful. But anyway, what was your sort of latest take on System 1?
We covered this in my Substack. Well, we cover everything basically in my Substack. So the team of 4 of us, we really like this. We think this is such an interesting company. It spent years creating and investing in these products that didn't seem to be going anywhere. They've launched them now, and they seem to be doing really well. But as you correctly say, the results were good, decent results. But they accompanied it with a trading update Q1 to June this year, where they've had a bit of a soft patch. And they did give credible sounding reasons for why they think it's just a temporary setback. But as you can see from the chart there, it's well off the highs, about a third off the highs. We think it's actually looking interesting again. I was tempted to just dip my toe in with a small starter position here, but I didn't in the end. You've got quite a wide spread as well, although the actual prices are usually well within the quoted spread. So we think it's an interesting company. I don't know what the competition are doing, though. There must be other companies offering similar services. But System One has a very impressive client list, and I think there's something interesting there. I think it's owner managed, and this is another one where you've got pots of cash on the balance sheet, so very well financed. So we like it, and I think it paid a divvy and a special divvy, I think, as well, wasn't it? But there weren't huge amounts. So yeah, thumbs up from me cautiously, but I don't know how the next year is going to pan out. It's going to go one or the other, isn't it? You know, if they recover and they say Q1 was a glitch, you could have nice upside on this. If it remains soft, and who would want to bet at the moment on the advertising sector staging a big recovery? Probably not anytime soon. So I don't know. Over to you, Paul. So I'm a bit not sure on this one, but I do like it. So yeah, your thoughts, Paul?
Yeah, I like it. Even though, I mean, marketing is not my type, usual sort of thing, because it has, as you rightly point out, lots of big competition, probably the likes of Facebook and Google and all the other guys, probably have a whole raft of them out in the States. However, advertising and marketing is definitely moving away from the big advertising agencies, because what you're seeing is if you're a Unilever and you're a P&G who literally have billions of pounds they spend on advertising, they're now bringing that in house and have been doing for the last 4 or 5 years, and they're buying software like this to basically improve because when they do a big advertising campaign, typically when they spend £1 billion, half of it works and the other half doesn't. Okay, and that was just terrible efficiency and huge error rates. Now that we're moving to a more precise marketing and promotional sort of like client list, it's reducing the overall size of the market for the agencies, because they're not getting the benefit of this extra $500 million, which is just jam for them, you know, because they haven't actually delivered. And when you go on the precision, it means that the technology providers, the likes of Celebrus Technologies, System One, are providing sort of like single shot, single solution software that allows the likes of P&G, Unilever, and also the advertising agencies themselves to better hone and target the guys, consumers. So these will benefit on a substitution of essentially improving the efficiency of sales and marketing. So I like it. On 13.5 times PE. I mean, just look at WPP this morning. I mean, they came out with a shocker. Was it yesterday? I can't remember.
It was yesterday. I was just going to mention that one. We've been quite negative on WPP on my Substack for a year. Well, since we started it 6 months ago, and then prior to that at Stockopedia. We're negative on it. The really shocking, I mean, WPP looks as if it could be in trouble. I think it's losing a lot of business to a big French rival, isn't it?
Publicis,
is it? Yeah.
Publicis,
and the thing is, going back to balance sheets, WPP has a diabolical balance sheet. The net tangible asset value, get this, Paul, brace yourself, it's almost £5 billion negative.
Yeah.
It's unbelievable. I mean, it's so irresponsible.
You know what the common entity is on the on WPP?
How do you mean?
Well, there's Sir Martin Sorrell. We used to run it, and now what's the balance sheet on his S4 Capital like?
Oh yeah, that's diabolical as well. Good point. So he's gone from hero to almost zero, really, isn't he? But
he's done the same. He hollowed out the balance sheet of WPP, and he's done the same for S4 Capital.
That's a really good point. I hadn't linked the two together, but yeah, no, I think WPP is definitely for me avoid like the plague. I wouldn't touch it. I really wouldn't.
But I think you need to be I think the big point is that you need to be in the right spaces in sales and marketing. The technology, improving the return on, the ROI, return on advertising spend, and if you can, which means for the big agencies, the Publicis, there's another one I can't remember. It's in Europe, which is a massive one. And obviously WPP.
Does something, isn't it? Devereaux.
Yeah, something like that. Yeah, that basically
you on Holdings, don't you?
Yeah, and what it means is basically the TAM, the total addressable market for advertising, is shrinking, but it's transferring to the guys who are doing the more improved software.
So stuff. Yeah, no, that makes a lot of sense. I think, well, I'll avoid the sector.
Yeah. Okay, we've got a couple of people asking about CML Microsystems. We've got Andrew Collerton and somebody else. Oh yeah, SE81. They basically, these guys do RF sort of custom designed chips for products that go into all kinds of different items. Their bread and butter used to be going into these sort of Tetra handheld communication devices, but through acquisitions and new products, they've now got into all types of 5G communications, IoT, digital radio, and the big shout, which came out this morning, they won a $30 million contract, was in satellites to produce IoT satellite communication devices out into the field, rugged devices, rather than just but they also do the ones for sort of like handheld as well into satellites. Anyway, what was your take? The shares have responded pretty well, up 10% today.
Yeah, very illiquid, this one. It's really difficult to buy or sell. I've followed this over the many years, actually. It's always looked a very interesting company. It's going through a bit of a soft patch at the moment, profitability-wise. It used to be much more reliable, made, you know, sort of low to middle single-digit millions of PBT every year. So when you think of a small microcap chip designer, you think, oh, hemorrhaging cash, loss-making, probably about to go bust type of thing. But this one is different. It's a good business. Also, very interesting angle on it with the property. It owns a business park. Can't remember where, somewhere in the southeast, I think. And they're now commercializing that by building on the surplus land. Looks lovely, actually. I looked it up on Google Maps and went to satellite view. You know, be a nice place to work, I think. So yeah, I like it. I think it's very interesting. Don't really understand the business, but I just look at the numbers. And there was a big announcement today. I think you know far more than me about this one, Paul. You bought some recently, didn't you? A while back, a few weeks ago.
I bought about, I don't know, a year ago. So I've got a full position in them. I mean, what I like about it's 75% gross margins. They provide tailored or bespoke sort of like communication devices, which they're sort of like the modus operandum is ultra low power, and so they're very you know, can be out in the field without any battery support, and they can just carry on going forever and ever. But they're not mass sort of like, they don't compete against the likes of Intel or Nvidia or these kind of guys. They're very much sort of like bespoke type of products that might go into 500,000 units or 1 million units, and that's why they can generate such very good gross margins. They've been suffering in the industrial sector from destocking for ages, but the balance sheet's very good. They've got spare land they're looking to sell off, and if you actually read between their lines in their last trading update or last set of results, they're saying they've got a very good pipeline going forward. Now they've got to convert that, and the way I read today is that we might now have reached a bottom, because they have been talking about this sort of inflection point. And I'm hoping it's going to be one of many. If they do have a very good, encouraging pipeline, it's going to be one of several sort of like, you know, big orders they can actually do over the next few years. And that's what the market is hoping. But I think it's still very, very early days. That it isn't expensive.
No.
And there was a big shareholder who bought a shed load of shares. It was when that April bottom was around about there, 220. He bought a couple of million shares.
Oh, that's a good sign, yeah.
It is, but you're right. It's still, to me, it's still a show me story. But I think it just shows you that the technology is good. Nobody's going to put a $30 million contract to a small UK business unless the technology can deliver.
Yeah, that's a really good point, because that was the news this morning. Funnily enough, I was just reading up on this before I joined you on this call. Yeah, big contract news today, $30 million over 12 years, though. So it's only, you convert that into sterling, that's about £2 million, isn't it, per annum? Yeah. Well, that's assuming it's spread evenly. It might not be. But no, I think you might be onto something here, Paul. I think this looks pretty interesting, actually. It's well established, so we're not taking sort of IPO risk with this. It's been around a long, long time. Do we know what the directors' shareholdings are with this one, Paul?
Yeah, I could get it, but I don't know it. I don't think they own a huge amount, but I could be wrong. I'd have to have a look, to be perfectly honest.
Yeah, so no, I think that you could do all right on this. So I like CML. Yeah.
We'll wait and see. Okay, we've got a question from Rebecca. She's asking about Carclo, which is basically does polymer parts which go into medical, and they'll go into industrial applications, sort of like plastic molded precision parts, I think they are. And anyway, I think they came out with some news today that they're going to, unfortunately, their shares are going to be suspended on the 1st of August because of the date, a delay to their audit. How did you interpret the announcement?
I haven't looked at it properly. I had a brief. One of the team did a brief write up on it today. Yeah, it's obviously a worry, isn't it? I'm surprised the shares didn't drop more actually today. I think quite a few traders are in this share. I know I've seen it discussed online. In my view on it, I followed it closely over the years. It's a high risk, high reward share where the business really looked as if it was going to go under. But they are turning it around now. I think today's update was in line, wasn't it? I think. Oh no, it was ahead. That was it. It was actually, they said that's probably why it didn't drop, because they said the March, I think it's March 25 results, currently unaudited, they said are actually ahead of expectations. Now we don't know how much. Often it's just slightly ahead. Your main issue is a balance sheet orientated. It's got a very, very cash hungry pension scheme, and people are looking at the deficit coming down, but the actuarial deficit is gigantic still. So do be aware of that and check out. And basically, it consumes the finance costs and the pension cash contributions consume all the cash flow, basically. So this is a geared play where if you're bullish on it, you've either not done your research properly on those issues, or you might think that the pension deficit might melt away, because some of them are. And also, you might think it's operationally geared. They're trying to raise their operating margins, and if they get them up a little bit more, it could then actually start generating decent cash flows and pay the debt down. And it does have freehold property as well, which I think is why the banks have probably been lenient. So I think I can see the bull and the bear case on this. Personally, I'm not calling it either way. I don't know how it'll pan out, but it doesn't, particularly after that sort of rise, when you know there are lots of traders in the share. I don't want to be taking the other side of the trade while they're banking their profits, to be honest. It was a good call, wasn't it? Look at how well.
Yeah, no, it's done very well. I mean, it's difficult to know, isn't it? It could just be something simple that they haven't sort of dotted the I's and crossed the T's and all this sort of stuff. But it could be, they're sort of debating about the going concern statement.
Well, I was going to say, I think these are usually going concern type issues, aren't there? So I think it did refinance the bank debt, though. So if it's got a sort of over 12-month runway from today's date on the bank side of things, and they have to do stress tests in the going concern thing, again, that might have thrown up some problems, because it is, it is highly geared. So yeah, I wouldn't be, personally, I wouldn't want to hold a share that's already said, look, we're going to have to suspend them, because once shares are suspended, you don't, that's when sometimes some nasty stuff comes out the woodwork, and sometimes they don't even come back from suspension, or you have to wait 6 months sometimes, or even longer. So personally, no, I always ditch things if they say they're going to be suspended, but everyone's got to make their own decision, haven't they?
Yeah, no, absolutely right. I would add, not only with the going concern, which would be a worst case, but given the recent results from Begbie's Trainer and from FRP, which the insolvency guys saying that they're seeing buoyant conditions. And have a think how your stock, what condition their customers are in, and you might find contract manufacturing, which is what Carclo does, into industrial companies. If they've got weak balance sheets, occasionally you can get, unfortunately, defaults or bankruptcy by your customers, and therefore you have bad debts. And one of the reasons why I raised that is that there are certain stocks that have high customer concentrations. Celebrus Technology we talked about earlier on, as I think it's 50%.
It is
in a channel partner. So you've got to think about not only the company, but the company's customers and how resilient they are in a downturn, particularly if it's a severe downturn in the second quarter, which is what's currently happening. And I'm sure it's one of the reasons why there's a bit of a spike in insolvencies, and obviously things, if it's in the retail and leisure sector, then it's NI which is struggling as well. But
yeah, no, those are great points, Paul. And I think a good question to ask management on these webinars when they do the Q&A is to ask the finance director, well, what percentage of your receivables book is insured? Because of course companies can buy insurance over the receivables. And if they don't give you a direct answer on that, or if they say that they're not insured, then you've got, as you quite rightly say, there could be hidden risk there. Yeah.
Okay, good. We've got a question from Paul the Parrot. He's asking about Grainger, which is basically it does the biggest UK landlord, and it rents them out, going through build to rent. It's got two parts of its business. It's got an old part, which is sort of like a old, used to be government-owned homes. It now rents out, and it's selling those over time when the tenancies become mature. And then it's putting that money into its build to rent. The shares trade at roughly around about, I think it's something around about 40% discount to net tangible assets. I don't know what your views on Grainger is.
Yeah, can you give me the ticker, Paul? Is it GRG or is that Greg's?
It's GRI.
GRI. Yeah, because we have looked at it this year, but I can't remember. Oh, sorry, my spreadsheet's painfully slow. Let's see if that might load up. We looked at it on the 15th of May, and they marked their own homework very generously here, saying they produced an outstanding performance. This was H1 results to March 25, and they say the outlook is excellent. EPRA NAV was up 1% to £3. What are they at the moment, Paul? They were £2.16.
Yeah, 207.
Well, that's a big discount, isn't it, to EPRA NAV? I normally work on the basis that the EPRA NAV is probably 10 or 15% overstated. But even then, you've got a lot of margin for error there. Loan to value on the debt looks okay, 38.5%. I think generally most people are happy with anything under 40%. Buy-to-let landlords, we think it's quite interesting. So we like this one. 4 out of 5 stars we gave it, amber green. So do you know what the dividend yield is, Paul, on this one?
I think it's about 5%, actually, if I remember
pretty good,
rightly.
Isn't it? Yeah.
I mean, basically what they're doing is they're converting in the autumn into a REIT. So if you hold this stock in your ISA, then the company doesn't pay any tax, and you don't pay any tax on the dividend. So it's a double win. I like it. I think it's a good, solid, share that if people want, decent performance for long term as an income stock, then it fits the bill. And I would say also there was some quite interesting news today. I think it was from the Chartered Institute of Surveyors. They were talking about how the rental market for mum and pop renters is dropping out for 2 reasons, mainly because of the new rental rights, which is obviously hitting a lot of people. 2, they lost interest. They lost a few years ago. They lost the ability to basically offset against interest and that kind of stuff. And so what it means is that actually rental prices, rental to individuals is going up because the market is shrinking. There's supply, and the other thing which is also happening, and I know it's a slight aside because they don't compete against them. But you've got, when I went to Abersock, it was amazing how many positioned houses were being sold. And because what's happening now around the coasts, for second homes, the councils are charging 2 or 3 times the council tax, and it's forcing people to sell. So what you're having basically is a shrinkage of the overall rental market, whether that's for holiday homes, whether it's second homes, or whether it's basically mum and pop providers. And I think Grainger's going to do well, actually. I don't own any shares, but it's right on my sort of like buy list, definitely.
Yeah, I think it's very interesting as well. And the UK has a massive structural problem, as we know, with inadequate private rental markets, and we have these sort of accidental landlords. Well, like me, I've got a buy-to-let. I bought the flat next door to where I live, and I rent it out so I can choose who my neighbours are. But I don't make any money out of it. Financially, it's a dead loss, really. You're hoping for the long-term capital gain, of course, aren't you? But I think I must say on the second homes, without wanting to sound like a socialist here, because I'm definitely not that, I actually think it's really selfish of people owning second homes that they leave empty most of the time. And forcing people to sell those by charging them more council tax, I think, is a good thing. And that could then actually add to the private rental stock. Instead of a house being empty, it might be bought up by a buy-to-let landlord or owner-occupiers. So I think that element of it is actually a good thing.
Unfortunately, ideology doesn't work practically because behaviour changes them. So what's happening? What's happening is you're getting a whole lot of holiday homes being sold, less investment into those areas through people renovating, doing kitchens, and buying tiles from Top Tiles and this sort of stuff. And what you're seeing is jobs being lost by the local community. So they're having to roll back the increase in the.
I don't buy that argument, Paul, because I think if you've got an owner-occupier or a property is permanently occupied instead of being empty, apart from a few weeks in the summer, that boosts the local economy. Because the whole thing about these second homes is that the villages are hollowed out because there's nobody living there, and the shops and the banks closed. So I don't know. We could have a vigorous debate on this, Paul, couldn't we?
Google it, Paul, because I did when I was in Abersoch, and they've had to take it down from three times the council tax to 2 times because it's hitting the local market, job market, and the amount of people coming in for restaurants and basically DIY. I mean, it's absolutely annihilating the local market. But anyway, have a look. Google it and have a look.
I'll do some more research. Yes. Excellent.
Yeah. Okay. On the same vein, we've got CLS Holdings, which basically is a REIT of all things offices in the UK and Germany. And the reason why I raise it is simply because it's trading at such a massive discount to net tangible assets, over 60%. And because it's got quite a lot of office and infrastructure out into Germany, it might be a beneficiary of all that basically 500 billion budget that the German government is putting into infrastructure and to basically buildings and stuff out in Germany. Anyway, it just seems an anomaly to most REITs.
It is. I mean, most REITs have got substantial discounts to NAV, although a lot of them have done quite well. We were on this area about a year ago. I've been talking about REITs, and we've done quite well on these. The other interesting thing about them is they were barely moved. In fact, some of them went up during the tariff 20% market crash. So these are nice safe havens, and you often get very, very good divvies. I do own CLS Holdings myself. I've held them for about a year. You're quite right. The discount to NAV is extraordinary. It's got to be one of the biggest, if not the biggest, out there in REITs, which makes you think something's wrong. And they have had some problems with vacancies, and the loan to value was a bit high. It was just slightly over 50%, but that's now come down to 47%. So it's a little bit on the high side. And I think the market's also worried about debt maturities, but I think that's a red herring. I don't think they're not likely to have any problems refinancing the debt, in my opinion. Quite a lot of it is European property, so they can borrow really cheaply in euro-denominated debt. And they've just, in the last few days, 10 days ago, they announced 41 million euros of 2 property sales at a 10% discount to book value. Well, the shares are on about a 60% discount to book value. So selling them for 10% less than book. Now, that might be cherry-picked. It might be the best properties that they're selling. I don't know. But either there's something awful is going to happen here, or that discount to NAV could disappear. Now, the other issue is it's about 60%, very roughly, owned by a family trust, I think.
Right. Okay.
I've done some digging. My sources tell me that they're pretty benign. They're not likely to shaft other shareholders by taking it private. They just like living off their divvies, and they're not really engaged with the company. So I don't think that is necessarily a threat, but we don't know, do we? It's always a bit risky buying something where somebody or a family have got a completely controlling shareholding. You were talking about that with Mike Ashley, weren't you? And
yeah,
at Fraser's, people are uncomfortable with his dominance there. So yeah, have you looked at CLS?
I haven't in great deal. I would say though, there's lots of value to crystallize there. It just needs the owners, the people who are 60% to say, right, I want to crystallize value, and I'll sell out to an infrastructure fund, and they could probably make another 50% on top of where they currently are. But,
yeah, I mean, it might come. Yeah, you're right. It could well be because you've got KKR and a few other American massive investors looking at buying up REITs, aren't they? It's a sort of wholesale change of ownership, isn't it? From stale bulls in a lot of these REITs who've had their fingers burnt by owning them, when interest rates shot up. And then you've got new investors, mainly from America. It seems they're buying up everything, aren't they? Who see the value.
It's dead. You haven't got to be an Einstein. It's dead easy, isn't it? You have basically Apollo or Blackstone. They borrow at basically the same rate as the central banks, and CLS borrow at 3% or 4% above base. I mean, you just made 4 or 5% straight away, on a recurring basis. So it's a no-brainer, isn't it?
Yeah, really good point.
It's that easy. Okay, we've got Ben Sharman. He's asking about Hunting, the oil and gas services business. Came out with an inline statement, I think, this week, but they announced a share buyback. Shares shot up. What's your latest on Hunting?
I really like Hunting. We've spoken about it a few times before, haven't we? Yeah, here we are. It was yesterday, Wednesday the 9th. It put out, it absolutely shot up. It went up about 13-14% on, I think it was an inline update, but quite a substantial buyback. And this, again, is the hidden value of strong balance sheets. It gives them optionality. It's actually, it's got an incredible balance sheet. It's something like $800 million NAV. Yeah. And it's got net cash. Yeah, here we are, $812 million and a net tangible asset value. Remember, that's not including any of the goodwill or intangibles. Net cash, $79 million. And the market cap's only about just about 500 million, isn't it? So that buyback of $40 million, that's going to be, well, converted into sterling, say 30. So that's going to be 6% of the market cap. So that's quite a chunky buyback. They've reiterated full year guidance of 135 to 145 million dollars EBITDA. So it's on a low PE. I think you've got moderate dividends, but you've got these big buybacks. It's doing acquisitions as well, bolt-on acquisitions, using this big pile of surplus capital it's got, basically. So it's doing acquisitions, all self-funded, and the buybacks and divvies. And they're still net cash, and they've got a very substantial borrowing facility. So management, I don't know, it's subjective, but it's an American CEO who comes across well on webinars, I think, as seemingly on top of everything. But you never know, do you? People can bluff. So I think it's really good. It is cyclical. It's mainly for engineering group focused on oil and gas. And he did say, the CEO is very open about it, and said, look, we are a cyclical business and we've no idea what the oil price is going to be in 3 months' time. So he said we can't predict how 2026 will pan out. And they've had some big orders from Q8, I think, which they're working through. So it's a sort of, they do need to keep refilling the hopper with the contracts, but the order book's quite big and they've got a large pipeline. He was talking very bullishly about the pipeline and the prospects yesterday, but he's American, so they're always super upbeat about everything, aren't they? But I think it looks really interesting. You've got low PE, decent shareholder returns, and an absolutely bulletproof balance sheet. So yeah, I like Hunting.
Yeah, and it's still cheap compared. I think it's about trading about 4.5 times EBITDA compared to the competitors, which are things like Halliburton and Schlumberger, which are on 5.5 to 6.5 times EBITDA. So it's certainly not expensive. And it's 11.5 times PE as well. So yeah,
it's quite high margin as well. It's specialist products. He said one of the standout phrases in the webinar that stuck in my mind yesterday was the CEO said, "There's not many people in the world who can do what we do." You know, it's really specialized products, and they're going much more into subsea type engineering with the acquisitions they've done, which they're talking about. They're saying it's very high margin work, and they seem to be paying sensible valuations. He was very disparaging about Britain, about the North Sea. He said it's just a UK policy, government policy. He says absolute disaster.
Yeah, I know.
He's sitting on all these reserves that are local and are not being tapped, and we're importing LNG from Qatar and America. Oh, it's
Yeah.
crackers.
No, he's spot on. Okay, we got on the same sector, a specialised oil and gas. We got Carclo. He's asking about Plexus. Any comments on it? Basically, these guys do that POS grip that helps seal off gas and methane emissions at wellheads. I think it's raised some money and it just bought some kit, hasn't it? That it's renting out. What would you like? Just quick thoughts on Plexus.
Quick thoughts. Yeah, absolutely fine. It was all they're trying to be more shareholder friendly now after we had that awful 5-month silence last year and then a placing which was horrendous. It was such a pity because if they'd done the placing when it was up at 20-25 pence, instead they dragged their feet because I don't know why, and the placing was eventually done at about 6.5p. So this is my biggest holding, so it's been a real roller coaster. But no, I think it's world-class technology. There's no doubt about that. The business is coming alive again. They're expanding the rental fleet. It's basically everything as expected. They just did an operational update, which is really helpful. And the CEO did a video as well, a short video. But would I have bought quite so many if I knew that there was going to be a long gap in between the contracts? Probably not. You know, I did overbuy it really, but I'm very happy with the strategy. I think it's got a lot of potential. Probably for the time being, maybe priced about right. So I'm not sort of pumping it in any way. I think for me it's just a long-term hold, and I'm happy with progress. I thought the operational update was good. And they got some of the new equipment is arriving towards the end of this year, which it was sooner than I thought. So the financial year ends June, so we should see a good uplift because the industry is crying out for this kit. It's very, very high margin and incredibly rapid payback. It's about 6 to 9 month payback on capital equipment. I mean, I don't think I've ever seen that anywhere else. So I'm quietly excited about this, but don't expect miracles overnight.
Have they got the internal systems to do a rental proposition? Because obviously this is new to them. They've previously been selling them, and you've got to manage the maintenance, the servicing, and the utilization rates to be and around the world to be able to, you know, basically make money. And given it's new, is there any? Have they got the systems in place to be able to do that?
Yeah, definitely. It's not new, actually, Paul. They've been doing this for decades. They've just gone back into that market because it's complicated, but they sold off IP in order to stay afloat. So they were blocked from doing the rental for about 3 years, but that's expired. So they're going back into it. And during that fallow period, they made huge improvements to the kit. So what they're saying is their products are now they're the only game in town for very high pressure, high temperature applications. Hark at me trying to sound knowledgeable about wellheads. I'm just regurgitating what they've told me. I don't understand it at all.
I'm sure you're right.
But okay, it's a very interesting little company, world-class technology.
Okay, let's move to IT. We've got Tai-Jun Lee. He's asking about Bytes Technology, which has been a bit of a darling on the stock market. It does it's a value-added reseller of software in the UK, typically cloud software and cybersecurity to public sector and to private companies. Unfortunately, it's seen a slowdown over the last sort of like last quarter in terms of deferred orders. The shares got walloped, down 25%. What's your sort of view on these sort of like, you know, big digitization transformation projects that it does for the public and the private sector?
Well, we were pretty negative about it in 2024, and then in 2025 we couldn't get above 3 out of 5 stars, so amber as we call it. We just didn't really understand the valuation. It was very highly rated. Does have net cash on the balance sheet, though, a decent pile of net cash, about nearly 10% of the market cap. But we just couldn't understand why, as you say, basically it seems to be a reseller of things. We couldn't understand why it was on such a premium rating. Then, of course, it got clobbered with a profit warning on the 2nd of July. Dropped about a third, I think. Has it recovered, Paul? It was £3.42 when we looked at it.
No, it's 3.40 at the moment.
So yeah, oh look at that! It tried to bounce. It's gone back down again. So that's not good, is it? No, we just don't see any attraction with this one. So not for me, I'm afraid.
Yeah, I would just add that just be careful who you choose in value-added resellers of software, because as the industry has been migrating to the cloud, then you don't need much customization. Everybody gets the same product. That's the whole point of having cloud. And so consequently, it means that the total addressable market for, basically software is for implementations and for servicing of it is less for the value-added resellers. And it's particularly hit the lower level guys out in India, the likes of Infosys and these other guys out there. But where you are, these I think Bytes do cybersecurity and AI, and on that basis, a lot of money is going to AI. But again, I would say AI and cybersecurity is sucking money out of other areas of IT and software. So be careful where you play.
Yeah, that's a really good point, actually. So presumably, because it was involved in cybersecurity and AI, that's why investors probably put it on a high rating. It's quite interesting when you look at a chart like that, isn't it? That how can the market get it so wrong about the company's performance? A lot of people imagine that the chart tells you everything you need to know and that people will anticipate deteriorating performance, but actually very often they don't. You just get, as with this, vertical move down by a third. It's quite surprising, isn't it?
Yeah, no, you're right. Okay, we got another one which has unfortunately had a bit of a profit warning. We got Craig W asking about Macfarlane, which I think they do sort of like special packaging, protection packaging for people. Scottish company. Shares are down 14% today.
Yeah, well, it's very disappointing. One of my team looked at this one today. I can't remember if it was John or Dave. But yeah, we've been stressing the value in Macfarlane shares for several years now. I think it always goes on my top 20 favorite shares list each year and never goes anywhere. And then, but we finally thrown in the towel on it today and just said, look, we're dropping from amber green to amber, just neutral on it, because very disappointing update today. They've missed by quite a bit, and it's a sort of long list of headwinds they're facing. But the bottom line is, it's competitive. They're just a distributor of packaging. Obviously, it's the sort of thing every customer is going to shop around, aren't they? So somebody somewhere must be undercutting them. That's still a nice business, don't get me wrong. It's profitable, but I think we've thrown in the towel on being bullish on this. I think we're just neutral now. And it's done lots of bolt-on acquisitions for sort of geographic infill, if you like, to get more coverage. But looking at the numbers, it doesn't. I mean, the long-term track record is superb. If you zoom out on the chart and the P&L over, say, 10 years, it's been a great success. But it does seem to be kind of stuck in the mud a bit at the moment. So I'm imagining you're not going to be terribly excited by a packaging distributor.
No, it isn't my kind of sort of scalable technology, 80% gross margins that I would typically go for. But
and there was a larger, much larger packaging distributor. I think it's DCC who reported today. And that's on a similar valuation to Macfarlane, so PE of about 10, but you've got a much bigger and more stable business, arguably. So of the two, I can't really see much appeal to choosing Macfarlane over similarly good value, larger competitors.
Yeah, good. Okay, switch sectors. We've got Andrew Kay's asking about Hostelworld, which I think came out with some report today. Basically, these guys are a broker of all things selling beds and accommodation at hostels for young people traveling around the world, both in the UK and in Europe and stuff. I don't know what was in the announcement, but the shares are down 8%.
Yeah, they're down sharply, aren't they? I winced when I saw that because my friend and former colleague Graham Neary gave a talk about Hostelworld when we were at Mello recently in June, and we all thought it looked really good. So decent value and so on, but obviously you can see from the chart there it has had a big rally, so the market is not as forgiving, I think, where something's had a good run. I have a feeling, I can't remember, we did write about it today, I think it was it in line, the update?
Yeah, I didn't read it, to be perfectly honest.
Yeah, but I think it was in line, but it's coming back to me. I think they said H1 was a little bit tepid in terms of the growth. There wasn't much revenue growth, but they're expecting more in H2, and the market doesn't like H2 weightings, does it? I mean, it's a very good recovery. Hostelworld, really got into trouble, as you would imagine, during the pandemic, but they survived. They've paid down the debt. It's in much better shape now. we think it's quite a good business. So if it keeps falling, it might be one that we can have a look at and see if we want to grab the falling knife. Yeah.
Yeah, I know it's trading at, I was just looking at 12.5 times PE actually, and it does have cash on the balance sheet, so it looks good value actually.
It is quite good value, yeah. And the story there at Hostelworld is they've got their own sort of social media app where you can chat to other people who are booked in to stay at a particular hostel. And this is mainly for young people. I think a lot of hostels have no over 40s rule. I
really?
Think
highly
discriminatory. You know, what about my human rights?
Yeah, exactly.
But I think they probably think over 40s are going to be perving over the young people. So, which I think again is pretty a sweeping thing to say, isn't it? So, but they've got this social media app. I'm not convinced though. I mean, I'd like to hear from young people who've booked through Hostelworld and can tell us about the app, and do they find it interesting to chat to people staying at a particular hostel just because they happen to have booked through Hostelworld? That's the question. I would have thought if I was going to stay in a hostel, you know, younger me, and I wanted to chat to the people, I'd just go to the hostel's website or to probably on Facebook. So I don't know whether the Hostelworld app is used or is valuable. If it is, then that could be a nice extra upside on the shares, couldn't it?
Yeah, no, absolutely. Yeah. Okay, got a quick one from Letitia09. He's asking about Greggs. You mentioned it earlier on. Obviously, they've been hit by the hot weather, people not having as many coffees and sausage rolls, I guess.
Yeah, we've all got our pet theory about why Greggs is struggling. I think that it strikes me there are probably operational issues there as well. They faff around with these coffee machines. It takes too long to get served. The queues are too long. I mean, I think it's a terrific business. I did buy some after the an earlier profit warning. I paid about 19 quid, I think, and then it went up, didn't it? Yeah, to about £22, and I was sort of thinking, starting to feel quite smug about that. And then we got another profit warning.
Yeah.
It wasn't too bad though. They basically said, I think profits are going to be slightly below last year's. But if you zoom out and look at the 10-year performance of Greggs, it's phenomenal.
Yeah.
The P&L is growth peaking. They've got over 2,000 UK stores now. Some towns have several Greggs in them, don't they? But there's not really much competition that offers such good value. Fresh food to go. You know, I'm a fan. I think, I'll always pop into Greggs if I get the munchies when I'm out and about. Definitely. Yeah. You know, McDonald's now, you're paying nearly a tenner for a meal with a side. You know, I think Greggs is much better value. So I really like it. PE currently is about 13 times. Well, historically, you had to pay over 20 for Greggs. So I think the market's giving us patient investors a good buying opportunity here. I went through the numbers again a few days ago. You know, it's just a cash machine. It generates so much cash, decent profit margins, about 7-8%, which is very good for hospitality. Well, if you couldn't call it that, retail stroke hospitality. No, I think it's excellent company. Currently on mid-season sales. So yeah, I must buy some more actually, because I've only got a half position size in this. Are you tempted, Paul?
Yeah, we're talking about 13 times PE. I'm a bit worried about overbuild, I'm perfectly honest. I think there's a bit of a saturation in this sort of like fast food stroke, takeaway type stuff, because the supermarkets are really getting into it. You go down the supermarket and they'll give you, takeaway coffees and hot buns and pasties and all kinds of stuff. And I just feel as though it's getting very, very competitive down there. There's just too much. It's overbuild on these. That'd be my take on it. Which is why I think if there's a lot of white space, it's easier to do lots of growth. But I would just question whether the whole market for this sort of fast food or food on the go type stuff is getting a bit competitive.
Possibly, yeah. That's an interesting point. Another concern I have is shoplifting. In Bournemouth, people just walk in and brazenly steal the products with absolutely there's nothing to stop them. So they're having to put security guards in some places, and you've got the same problem everywhere, I think. So that's an issue. But they are trialing stores where they put it all behind a counter, in the old-fashioned way, and you have to ask the person. I wonder if they could automate it. That's another potential avenue, isn't it? Put machines in or something. But I think fundamentally very good business, cheap. I like it a lot. Yeah.
Yeah. No, good products. Okay, we've got Rising Bull 1985 is asking about Victrex. It's one I own. Basically, they do PEEK polymer that goes into industrial applications. PEEK polymer is very good for sort of like lightweight, durable applications. Goes into EVs because obviously it needs low weight and very durable aerospace parts, other sort of composites. It also goes into medical and industrial applications. Volume sales are doing good. Mix has been hit because there's less medical sales, and particularly into spine. They've put out some results, a bit of a show me story at the moment. It's sort of like, it's not great. So to me, you've got to basically believe it long term, the story, which is why I'm holding. But it's been painful. I'm 50% down. I don't know if you're going to get takes on this one at all, Paul.
Yeah, I just looked up my report on it here. We covered this on Tuesday. I think it was a mild profit warning, wasn't it?
Yes, that's correct. Yeah, down about 6 to 10% or something like that.
Yeah, here we are. Yeah, we put mild profit warning question mark, so we can probably take the question mark out. Yeah, it mentioned headwinds of macro, slow medical sector, forex. The sales mix deteriorated a bit. Still highly profitable though, but yeah, it's lowered full year expectations from 50.5 million PBT to 47 million. So far from a disaster. Unusually strong balance sheet, which obviously I like a lot, with only very modest net debt and 417 million net tangible asset value. We've got a 7.5% yield showing. Is that right, Paul? That doesn't.
Yeah, it's certainly quite high. It's
big yield.
Yeah, I mean they've got rock solid balance sheet. They've got a couple of really big sort of like mega projects. One of them is that they're developing a cheap knee that is a knee joint that goes into obviously humans. It's in clinical trials. They're hoping to get that success and then get FDA approval, which will be enormous. And they won that huge contract with one of the big offshore oil and gas service guys, Treatt, to do PEEK tubes that then allow the fluid between obviously offshore platforms and ships, and which is a huge contract potentially servicing out in South America and Brazil and the offshore there. So they've got some potentially massive projects, but it's a show me story. It hasn't come through yet, and frankly, it needs to generate organic growth.
Yeah, one of my readers actually, because obviously on my Substack we have the subscribers can leave their own comments, and it's great because it's lovely when you have someone who knows the company either from having worked there or being a customer. And I think this guy, was a customer for their medical products, and he said something. It's only scuttlebutt, but he said something along the lines of that they're not really competitive. When the sales rep comes to see him, the products are not as good as and are not as competitively priced. So I thought that was quite interesting, and that's kind of what the share price chart is telling us as well, isn't it?
I think they are competitive, but it's one of those things. Is such there is definitely more competitive, but they've got to basically deliver. That's what it comes down to. Yes. And they've had destocking, and we all know the macro hasn't been humming, and there's been in terms of industrial applications. But hey, we'll wait and see. But I wish I hadn't have bought it sort of like 18 months ago. But you are where you are. Aren't you?
Yeah, we have to live with our decisions, don't we? I mean, it might be one to average down on. Actually, I mean, looking at the numbers of this, I am quite tempted. Actually, I have to say. The other angle on it is there's a new CEO joining in quite soon, I think. Date to be confirmed, it says, but I think they've found a new CEO. So turnarounds can sometimes be triggered, can't they, by a change in CEO? So this might be one to do some digging on who this new CEO is, what their track record is. And it might be one to get in to buy before a turnaround, possibly. Yeah. And then, of course, we want to see Harwood popping up on the shareholder list, don't we?
Yeah, that would be a brilliant tick in the box.
Yeah, so I think Victrex looks interesting. I need to do some more research on it, but it kind of ticks my initial boxes for value type potential situation. So, yeah, I'll have a close look at it, Paul.
Brilliant. Okay, well, thanks everyone for your questions. We've been going now for 75 minutes, so we're going to go and it's time for a drink after all the sun. And thanks very much, Paul, for your excellent insights. Just to let everybody know, as a sort of heads up, it's going to be 2 o'clock on Wednesday next week rather than the Thursday. I'll send you an invite there, Paul, just to make sure. But it's 2 p.m. same channel next Wednesday rather than Thursday. So thanks again, guys.
Yeah, thanks to everyone, especially all our regulars. Great to hear from you.